Hello, my name is Nilomade Amanda Wulandari Sudirga. My student number is 377159. Here are my group members. There is Muhammad Faisal, Nikita Cendhani, as well as Sulthan Dewa. Now I'm going to explain how to solve problem 10 number 2. So this is the problem that we are going to solve. The first instruction is to prepare a detailed analysis of the changes in each of the following statement of financial position accounts for 2010 for land improvements, building, as well as machinery and equipment. Before we are going to solve the problem, let's see the following transactions that occur on 2010. In the problem, we are given this statement of financial position at December 31st, 2009. This will become our balance at January 1st, 2010, our beginning balance, because previous year ending balance is the same as the as next year beginning balance. So before we answer the first question, we are going to analyze each of these transactions to know which account that they are going to affect. Let's begin with the first one. The first one is that Lobos Corporation acquire a land costs $150,000 as a potential future building site. This is important to note because acting as a potential building site makes it an investment. So this is not going to affect the analyze for land account. Instead, it is going to be in the investment for land account. And then the second transaction is Lobos Corporation acquired land and building from Mendota Company in exchange for 20,000 shares of Lobos ordinary shares, which at the acquisition date, the market price is $37. So the second transactions affect the land and building account. The third transactions where Lobo Corporation purchased machinery and equipment at a total cost of $400,000 and with additional costs. So this will affect the machinery and equipment account. The fourth transactions is in an expenditure for parking lots, streets, and sidewalks. This is to improve the land, so it's land improvement. The fifth transactions is a scrap of machine. On June 30, 2010, this is affecting the machinery and equipment account. It's a deduction on this account. And then the last one is selling a machine on July 1st, 2010. This will also affect the machinery and equipment account as a deduction. So now that we know what account each of these transactions will affect, we are going to answer the first question, which is to prepare a detailed analysis of the changes in each of the following statement of financial position accounts for 2010. So here I've already made the usual format of a company's name, logo corporations, and then the name of the account, and then the year that we are analyzing. For the first account, we are going to analyze the land of Lobos Corporation. So first, we are making a balance at January 1st, 2010. To know the balance, the beginning balance, which is balance at January 1st, 2010, we are going to go back into the problem and see the statement of financial position at December 31st, 2009. Because as I said before, the previous ending balance is the same as the next year beginning balance. So we are going to find the land balance, which is $300,000. So we have the balance at January 1st as $300,000. Now the transactions which affect the land is only the second transactions, which is acquiring land and building from Mendota Company for 20,000 shares, where the acquisition date is 37. Where on the acquisition date the market price of the share is 37. But this price will be for both land and building. So first we need to find out how many costs for the land and how many costs the building. So I'm going to make that in the schedule first, schedule 1, to calculate the cost of land and building. So first I'm going to make the title computation of fair value of plant facility acquired from Mendota Company and allocation to land and building. Oops. From the question, we know that Mendota Company, Global Corporation acquired the land and building from Mendota Company in exchange for 20,000 shares of Lobo's ordinary shares, which at the acquisition date, the market price is $37. So the total cost of both land and building is 20,000 times 37. So we need to find the total cost of this land and building, which is 20,000 times 37, which is $740,000. $740,000. now we are going to find out how many goes to land, how many cost goes to land, and how many cost goes to the building. To find this out, we need to look back into the question and then find the percentage for the appraised values. We are not going to use this value and this value because this is not the values that is in Lobo's books, but instead we are going to use these values, the appraised values at the exchange at the acquisition date. So we note the amount appraised for the land, which is $230,000, and then the amount appraised for the building, which is $690, and then we sum them up. To find the percentage, we just need to divide the amount that we are calculating, divide them with the total amount. And then do the same thing for the building. And then we got that the percentage for land is 25%, and then the percentage goes to building is 75%. So with this number, now we can find how much the land costs by $740,000 times 25%. So we got that the land will cost $185,000. And then we did the same thing for the building to find the cost that we're supposed to put in the book. So 740,000 times 75%, and we got 555,000 for the cost of the building. Let's try to sum them up if it will match the overall cost, which is $740,000. Okay, so we got the right amount, which means that we are correct. So, okay, now that we know that the land costs 185,000, now we just need to put that in the analysis of land account. We note that down. Plant facility acquired from Mendota Company. Portion of fair value allocated to land. Schedule 1, we got $185,000. $185,000. Because there's no other transactions that affect the land, so we can just calculate the ending balance, which is balance at December 31st, 2010 is the sum of the beginning balance and the transactions that affect the land, which is $485,000. Okay, so that's analysis of land account. Now we are going to analyze land improvement account. I'm going to delete this and then just change the name of the account. Analysis of land improvement account. Okay, just the same as the previous one. We note the balance at January 1st, 2010, which is the same as the ending balance at December 31st, 2009, which is $140,000. $140,000. And then go back to the transactions, note down the transactions which affect the land improvement. It's the fourth transaction. Expenditure totaling $95,000 for new parking lots, streets, and sidewalks. So we note that down: parking lots, streets, and then sidewalks for $95,000. Since there's no other transactions which affect land improvement, you can just calculate the ending balance. Sum this up. Oops. And we got $235,000 as our ending balance for the land improvement account. Now we are going on again for the analysis of building account. It's like before, I'm going to delete this and then change the name using the same place. So the name of the corporations and then the name of the account, the year, and as usual we begin with the beginning balance at January 1st, 2010. The beginning balance is $1,100,000. $1,100,000. So the transactions which affect the building is the second transaction, which we have already calculated before, how much the fair value that goes to the building. So we're going to note that down. Plant facility acquired from Nikita company, portion of fair value allocated to building. So the building will cost 555,000 in the fair value, and then because there's no other transactions that affect the building accounts, so we can just calculate the ending balance again. And sum them up. So the ending balance for the buildings accounts is 1,655,000. For the last account, which is the analysis of machinery and equipment account, I'm going to delete this again, and then just like before, make the balance, the beginning balance at January 1st, 2010, which is 960,000. Here, for the machinery and equipment, we purchase, also sold, and scrap. Purchasing machinery will add more values. The number 3 is purchasing machinery and equipment, and then the 5th and 6th transactions is a deduction where the machine is scrapped as well as sold. So here we are going to make notes of cost of new machinery and equipment acquired. So we know that the total cost purchase is 400,000. So the invoice price is 400,000. And then purchasing this machinery has an additional cost, which we have to include in the account as well, because that is the cost to make the machine capable of being capable to use as an operation. So we put the freight, unloading, and unloading, 13,000, and then sales taxes, 20,000, And then the last one is installation. Installation at 26,000. We sum this up. And then sum the balance as well as the total purchase cost. We got 1,419,000, but this is not finished yet because we have a deduction cost of machine. So we will note that down too. Deduct cost of machines disposed of. The first is the fifth transaction, which is the machine scrap on June 30, costing $80,000. So machine scrap on June 30, 2010, which cost $80,000. Here on this account, we are not calculating the accumulated depreciation account, but we still need to put the accumulated depreciation account on the statement of financial position. But in this account, we can just ignore it. And then the second transaction is machine sold. The original cost is $44,000 on July 1st, 2010. Machine sold July 1st, 2010 at a cost of $44,000. Remember that we used the original cost, the cost when we acquired the item, instead of the cost the item is sold or the depreciation value. We use the cost when we acquire them. And then we sum this up. We found the total deduction cost. Because there is no other transactions which affect this account, we are going to make the balance at December 31st, 2010, and then we are going to deduct this minus the deduction cost. So the ending balance for the machinery and equipment account is $1,295,000. So we have finished the first question to prepare detailed analysis. Now we're going to the second question, which is to list the items in the fact situations that were not used to determine the answer to A, and to show the pertinent amounts and supporting computation in good form for each item, and indicate where or if this item should be included in Robo's financial statement. So the transactions that we do not use to answer the question number A is the first transaction, which is an investment. Okay, the first transaction, which is the investment. And then this number, this value here, and then the depreciation on the machine scrap, as well as the depreciation on the machine which was sold. So let's go for the first transactions again. A tract of land was acquired for 150,000 as a potential future building site. This transaction should be included in Lobo's statement of financial position as an investment in land. So it's not going to affect the land account, the analysis of land account, but instead it should be included in the statement of financial position as an investment. And then the second transaction, where we do not use these two values here for the land and building, is because this is not carried on Lobo's books. Instead, it is carried on Mendota's books. So we can just ignore that. And then the fifth transaction, where we ignore the depreciation, but still we should calculate the loss or perhaps gain if we gain any, as well as the accumulated depreciation in its respective financial statement, where I'll be calculating it on the schedule 2. So on the schedule 2, we are going to calculate the loss on scrapping of machine on June 30, 2010. Let's delete this. Okay, for this schedule, we'll begin with the original cost, which is the cost when we bought them, when we acquired them. It's 80,000 on January 1st, 2002. So now to find out the loss, we need to find the value accumulated, the value depreciated, which is accumulated depreciation, and then we also need to note the method that we're using, and then if there is any salvage value, then we also need to note that down. But because there is no residual value for this account, for this transaction, so we can just ignore that, and then the useful life is 10 years, and then it was scrapped on June 30, 2010. So to find the accumulated depreciation, what we need to do is to $80,000 to divide the amount, the cost when you acquire them, with the useful life, which is 10 years here, and then times the year, or the amount of time since you have acquired them, which is 8.5 years, because from January 1st to June 30, 2010 is 8.5 years. So we calculate that. But if you have a residual value, you need to minus the original cost first before you divide them with the useful life, and then times them with the years it has been used. But because here there's no residual value, so we can just ignore that step. And then because we already have the accumulated depreciation value here, we can get to the asset book value on June 30, 2010, where we need to minus the cost, and then we got $12,000. So now we got the numbers for the loss on scrapping of machine on June 30, 2010 is this, $12,000. So what we need to do for these transactions is that we need to include the loss, which is $12,000, in the other income and expense section in Lobo's income statement. And then we also need to include this 68,000 in the accumulated depreciation machinery and equipment account in Lobo's statement of financial position or balance sheet. So these two is what we need to note down from these transactions that we do not include in the previous account, but we should include them in the other financial statement. Okay, and then the last one is the sixth transaction, which is selling machine. We also need to make a schedule to calculate the loss as well as the accumulated depreciation. So I'll name it Schedule 3. Loss on sale of machine, July 1st, 2010. So the same format as before. We begin with the original cost when we acquire the item, that is cost January 1st, 2007. It costs $44,000. And then we calculate the accumulated depreciation. So accumulated depreciation, note down the method, straight line method. And then different from the previous transactions is that this has a residual value of 2,000. Transactions has a residual value of 2,000. So we note that down, that the salvage value of $2,000, and then with a 7-year of useful life. So we acquired the machine from January 1st, 2007, and we sell it in July 1st, 2010. So just like the previous one, we calculate the accumulated depreciation by dividing the cost when we acquire the item, but because there is a salvage value here, so we need to minus that first. And then divide it with the useful life, which is 7 years, and then times the time, the amount of time which has been used. So from January 1st, 2007 to July 1st, 2010 is 3 years and a half. Let's calculate that. So 44,000 minus 2,000 divided by 7 and times 3.5. So we got that the accumulated depreciation is $21,000. And then we know that the asset book value July 1st, 2010 is 44,000 minus 21,000, which is 23,000. But this is not the loss the company is facing because we are selling, so we have a gain which we need to calculate as well. So asset book value, the same as the one in the above, and then proceeds from sale, which is how much you sold the machine, which is 20,000. So we got 20,000 here. And then here you can finally calculate the loss on sale, which is the asset book value minus the proceed on sale. So you got 3,000 losses. So this is the last information from the transactions that we do not use. This too is what we need to, sorry, not that one. This one, oops. So this too is the one that you need to take note of, that we are not using to answer the first question, the A section, but we also need to note that down in the other financial statement. The accumulated depreciation is the same as the previous one, supposed to be included in the other income and expense section of Global's income statement, and then the loss on sale should be included in the accumulated depreciation, machinery and equipment account in Global's statement of financial position or balance sheet. So that's the answer for the second question. So we have already answered both the question for the A as well as the B instruction. I hope that I explain it quite well for you guys. Thank you for listening. Have a nice day.